Hello everyone. So today we are discussing the topic investments and securities. So when we're talking about investment, the first thing which came into our mind, why a person go for investment. So before investment, we need to understand if a person has an earning, then that person goes for the investment. So what is the earning? Whatever money or whatever salary a person gets from his business or from his daily work or from his service, it's termed as his earning. So from that earning, we spend some money for different activities, or that is termed as expenditure in economic terms. From that expenditure and income, whatever is left, that income minus spending or income minus expenditure, whatever is left is termed as saving. And that particular saving has different alternatives. So investment is basically a part of saving that an individual person do out of his earnings. So earning is divided into two parts. One is for current consumption and second part is deferred consumption. Current consumption means whatever we need to purchase for a particular month or a particular year. Or deferred consumption means which we can transfer or we can do it for the coming years. Suppose we want to purchase a house, we cannot purchase it from our earning in this particular month or this particular year. We need to save certain amount of money, and that saving will accumulate. That particular consumption is deferred for future. Current income can be treated as an income put away for future need. Saving is preserving the value of money not spent. So whatever the money is not spent, we are investing it in form of a bank account, in bank, that is FDs or RDs, or we can go for mutual funds, or we can purchase shares. So there are different avenues of investment. So that particular avenue where we are going to invest, we are actually interested in earning certain amount of return, and that particular saving is preserving the value of money not spent. Saving become investment only when they enter the financial system. So investing involves taking on more risk with regard to different types of investments in hope of earning greater return. Investing is allocating money into financial or real asset to increase the future value. So different avenues of investment, as it is mentioned earlier, financial assets and real assets. So financial assets include the corporate bonds or government securities, mutual funds, derivatives or insurance, money market and capital market instrument. Real assets include your precious metals, stones, commodities, etc., and real objects, that artifacts. To the definition of investment, what is investment? Till now we have understand what is saving, and from saving we need to invest certain amount. But what does actually investment means? An investment is a current commitment of rupees for a period of time in order to derive future payments that will compensate the investor for the time the funds are committed. That means, suppose I have purchased a FD or invested in FD for 3 years. So I am years. In that particular 3 years, I need to wait. And for that particular thing, what I am getting? Expected rate of inflation. Because during the passage of time, the economic conditions are changing and inflation rate are increasing. And for that particular thing, the bank is giving me interest in return. The uncertainty of the future payment. There is no guarantee. In case of FD, there is a guarantee, but in case of stock market instrument, there is no guarantee what I am going to get after 3 years or 5 years or 10 years of commitment. Thus involves making of sacrifice in present with the hope of deriving future benefits. The two most important features of an investment are current sacrifice and future benefit. It can be discussed in 2 points, that is point of view, that is financial, and second one is economical. If we talk about financial point of view, it implies deploying the funds in investment avenues to generate income in form of interest, return, bonus or dividend. Economic perspective, the economic investment is an investment for the formation of new or productive capital in form of new plant, machinery, inventories, etc. That is basically done by the industries. So investment in financial sense leads to the creation of financial asset and investment in economic sense lead to creation of physical or real assets. So if we talk about the individual person, we are actually investing in form of financial asset, that is share, bonds, debentures, FDs, RDs, mutual funds, etc. And we talk about economic sense, we are basically concentrating on the physical assets, that is the plant, machinery, or the land. So these two types of investments are interrelated and interdependent. Why it is so? It can be easily understood because if a particular floating as shares, the individual investors are purchasing the share and that money is given to that particular company, and from that particular money the company purchase the plant or machinery or any other thing. So it is interrelated. So it's a part of a financial system. There are borrowers and lenders. So without borrowers and without lenders, the financial system cannot work. The money invested in financial assets flow in form of capital to physical assets. Some of the parts of income generated by using physical assets flow as saving into financial assets and the cycle continues. Therefore, investment results in the creation of asset, either real or financial. Why invest? As an individual, why it is required to invest? First, to improve our future welfare. Second, to enhance our future consumption possibilities. Third, to regardless of why we invest, it is basically required for managing our wealth effectively. And fourth, protecting our assets from inflation, taxes and other factors. So coming to the nature of investment decision, basically the investment decisions are rational in nature, or the investors are rational in nature. They are risk aversive. They want to take risk, but they do not take unwillingly risk. So they calculate the risk before investing, and on the basis of their risk appetite, they actually take different type of risk. So as a risk moderator or risk neutral person, he is not going to invest in share market, but a risk taker person is easily going to invest in share market. So it depends upon the risk appetite of a particular individual. While investment decision is adequate compensation. If a particular investment is going to give me adequate compensation or adequate return, then only I am going to invest, otherwise I am not going to invest. Important terms in case of investment. One is rationality, that individual investors do not take irrational decision. Second thing, investors are risk aversive in nature, so they do not take risk just for the sake of taking risk. They calculate each and everything, and on the basis of their calculation and their risk appetite, they take the risk. Characteristics of investment. First thing is return. So whatever type of instrument we have taken or we have purchased, or wherever we are investing, we are expecting certain form of return, whether it is form of a dividend, whether it is a form of interest, whatever form, we are just expecting a certain amount of return, because we are sacrificing our present consumption need for future benefits, and for that particular purpose we require return. Second thing, every investment has certain amount of risk associated with it. So no instrument is free from risk. Liquidity is very important while investing, because certain very low, like real assets where liquidity is low. In case of shares, the liquidity is high. So it is very necessary, wherever you are investing, you need to think whether you need to maintain a good amount of liquidity. So before investing, it is required that we should invest in liquid assets, so that in case of money, if we need money, we can sell that particular investment and get the money. Hedge against inflation, that is also very important, that whatever instrument we are investing, it is very important that it should protect us against the inflation. And safety of the instrument is very important, because if the instrument is not safe, it is going to make the situation volatile, and it is not going to give any sort of return to the investor. Objective of investment. So there are different objectives, and from person to person the objectives may vary. So first objective is capital appreciation. If certain person required capital appreciation, they go for real assets because it is going to appreciate. Current income, like old age people, they require a regular income, so they go for monthly saving schemes. Capital preservation, there are certain person who need to preserve the capital. Suppose I got some money by selling a particular property. Now I do not have any way to invest that, just I want to save that property, that particular money, so I am going to fix it in FD, and it is going to give me certain amount of return. Speculation purpose, because there are speculators available in the market, so their main objective is speculation. Tax minimization is another thing, because salaried people, they get certain amount of deduction, and for that particular purpose also we need to invest. Then there are objectives like marketability and liquidity. Then coming to the types of investors, there are basically three types of investor: risk seekers or takers, risk avoiders or aversive, risk bearers or neutrals. So risk taker are person who are highly active in the stock market, and they are very active. That's why they are very active, and they take high amount of risk. Risk aversive persons are totally the persons who actually do not take any type of risk, or they are very moderate about taking risk. So their portfolio consists of balanced fund, certain amount of equity, certain amount of debt, or they can go for equal balancing. Risk neutral or risk bearer persons are totally, you can say, the moderate kind of person. So they moderate their risk pattern. So risk aversive people are those who actually avoid the risk. So their portfolio consists of 100% debt funds, while the risk neutral person, their portfolio consists of 50% of equity and debt. Investment process. There are certain steps in investment. First, as a portfolio manager, a person needs to understand the investment objective of a client. First step is just understanding the investment objective. Then take a security analysis, identify on the basis of whether it is a risk taker, neutral or risk aversive. Then go for selecting the securities and conduct the security analysis on the basis of risk and return profile. Then construct a portfolio for a particular client. Then review the portfolio time to time, so that in certain securities are not giving good returns, they can be eliminated from the portfolio. Evaluate the performance of the portfolio as per the expectation of the client, or as per the expectation of that particular investor. If it is not up to the mark, then try to rechange or reframe the portfolio. And then portfolio revision, that is the last stage, when we are going to again perform the security analysis and identify the securities for the particular portfolio and construct the. So the next slide is, what is the difference between investment and speculation? We have understood that there is one objective of speculation in our investment profile also. So there are basic differences are, when we talk about investment is very much cautious and conservative in nature, because investors are risk aversive in nature and very rational, while speculators are daring and careless. Talking about the reason for purchase, investment is always done for long-term gains, while speculation is done for short-term gains. Analysis. In case of investments, the scientific analysis is done. There are various tools available in the market, and various softwares are also available. On the basis of that, we calculate the worth of the security, while speculation is based on tips and hunches. Quantity of risk in case of investment is very low, while in speculation it is large. Stability of income, investment is very stable. Depending upon the market situation, it may volatile, but in normal situation it is stable, while in case of speculation it is uncertain and erratic. Length of commitment, in case of investment it is comparatively long, while speculation it is short. Source of income, mainly the enterprise, and in case of speculation, the source of income is market. And last one is gambling. That is also done in case of stock market, but it is basically related to lottery and horse race games. So in case of lottery, again it is very unscientific, unplanned manner. Again it is based upon hunches. There is no long-term gain or long-term objective. It is again based upon short-term objective. And that's all. Thank you.